Hey everyone, welcome back to YieldCraft, where we talk about dividend investing, US ETFs, and building passive income the smart way. Today we are talking about one of the hottest funds people are hyping right now, the SPYI ETF by NEOS Investments. It claims to offer a 12% plus yield with monthly income. And everyone's asking, is this the perfect dividend ETF or is it too good to be true? Let's break it down step by step what SPYI actually does, where that income really comes from, and whether it's worth it for the Indian investors like us. SPYI stands for NEOS S&P 500 High Income ETF. It launched in August 2022, so it's still a relatively new ETF. Here's what this ETF does. It invests in S&P 500 stocks, so you're getting exposure to the biggest companies in America. But here's the twist. It also uses options to generate extra income. Essentially, SPYI sells call options on the S&P 500 index. That means it collects premium from those options and then distributes that cash to investors as monthly income. So instead of just relying on dividends from companies like Apple and Microsoft, it is also earning from option premiums. Here are the quick facts about SPYI as of late 2025. Expense ratio 0.68%. That's higher than normal S&P ETFs. Distribution rate around 12% annually, paid monthly. 30-day SEC yield just 0.59%. Wait, 12% with a 30-day SEC yield of 0.59%? That's your first red flag. The distribution yields includes option income and return of capital, not pure dividends. The SEC yield shows the actual underlying dividend yield from the portfolio. This means that if the option strategy underperforms, or the market environment changes, the payout could drop sharply. Now let's be fair. There are real reasons investors are excited about SPYI. First, high monthly income. Getting paid every month at 1% plus sounds amazing. Second, equity exposure. You still own S&P 500 companies, so there's potential for a long-term growth. Tax efficiency. For US investors, SPYI uses Section 1256 contracts, which can have better US tax treatment. New age strategy. Covered call ETFs like SPYI, JEPI, and XYLD are trading because they offer steady cash flow when markets are volatile. So the hype isn't random. SPYI fills a gap for people who want income plus some market exposure. Here's where we need to slow down, because what looks like safe monthly income actually carries several risks, especially for Indian investors. Yield sustainability. That 12% isn't guaranteed. If market volatility drops, option premiums fall and your income could shrink. Also, part of the payout may come from return of capital, not fresh income. Market risk. SPYI still owns S&P 500 stocks. If the market falls 20%, SPYI will also drop. The options can only soften that a bit, not protect fully. Capped upside. Because SPYI sells call options, it limits how much it gains in a bull market. So while the S&P 500 might jump 15%, SPYI could lag behind maybe 8 to 9%. Short history. Launched in 2022. That's not enough data to judge long-term consistency. We don't know how it behaves over a full market cycle yet. Taxes for Indian investors. Here's a big one that most videos skip. You'll pay 25% US withholding tax on the income before it even reaches you. Then you'll have to declare it again in India and pay tax per your slab with foreign tax credit. Plus you have currency risk. If USD weakens against INR, your returns drop. So the 12% headline yield might translate to 7 to 8% actual return after taxes and forex conversions. If you're watching from India and wondering how to buy SPYI, you can invest through platforms like IND Money and Vested. The limit is $2,500,000 per year. But remember, US ETFs are taxed differently than Indian ones. You'll need to handle Form 67, foreign tax credits, and annual filings. And your returns are also affected by the USD INR exchange rate. So it's smart to treat SPYI as a satellite holding. So, is SPYI worth the hype? If you want steady monthly income and understand the option-based risk, it can be interesting. But if you're a beginner who just wants simple dividends from companies, it's not the best starting point. For me, I'd keep SCHD and VIG as my core. And maybe use SPYI as a small satellite for extra yield. Remember, high yield doesn't always mean high return. Sometimes it just means high risk. Thanks for watching. If you found this breakdown useful, make sure to like this video, subscribe, and hit the bell icon because I share new dividend investing insights every month. Comment below, would you invest in SPYI for that 12% yield or stick to classics like SCHD? I'll see you in the next video where we'll compare SPYI and JEPI side by side.